Welcome to the Research Desk. Today, we are dissecting a market reality that, well, it fundamentally defies conventional industrial logic. We're examining an industrial miracle that simultaneously presents as a severe equity vulnerability.
Right, and the subject today is Xiaomi.
Exactly. The central tension we are unpacking is absolute. Xiaomi may have just pulled off an unprecedented industrial feat by building a massive hit electric vehicle. Yet the equity itself might still function as a toxic margin trap.
Yeah, and I will be taking the opposing stance on the broader outlook. I'm going to demonstrate that a great product launch does not automatically engineer a durable compounding equity. Relying on low-margin consumer electronics to fund a second, structurally low-margin automotive business is profoundly dangerous.
Even with their specific advantages?
Especially now. It's happening precisely at the moment when valuation discipline matters most to the broader market. We really have to separate the romance of the product from the brutal mechanics of the stock.
I completely agree on separating the product from the stock. But I will be arguing that their unique ecosystem advantage makes this a triumphant industrial launchpad. But look, the numbers immediately mandate our attention here. We have to narrate the staggering market reality of the Xiaomi SU7 versus the Tesla Model Y Showdown.
And this is not a hypothetical future state competition, right?
Not at all. The data from the ground is absolute. Xiaomi has officially delivered over 500,000 EVs in 2025. Stop and consider the industrial weight of that single metric for a second.
It's massive.
It is. Legacy automakers take a decade to scale a new platform to 500,000 units. Xiaomi achieved it in an impossibly compressed timeframe. They entirely disrupted the established timeline for automotive manufacturing scaling.
Well, the sheer volume is undeniable, but the velocity is what demands forensic analysis. The critical metric arrived in January 2026. Xiaomi operated at a pace where the SU7 outsold Tesla's Model Y by a ratio of precisely 2-to-1 in that single month.
2-to-1? Against the Model Y?
Exactly. And they posted their first profit in the automotive segment. That validates genuine product-market fit. There is zero debate left about whether consumers actually want this vehicle.
Right.
Yet here is the valuation paradox we are here to dissect. Despite this absolute operational triumph, short sellers have accumulated and banked $1.8 billion betting strictly against the stock.
And that paradox is the foundation of our entire thesis today. Why would institutional capital place a $1.8 billion wager against the company that just outsold Tesla's flagship volume vehicle 2-to-1?
It all comes down to capital allocation.
Exactly. The market is entirely done asking whether Xiaomi can manufacture and sell cars. They have decisively proven they can. So the focus has aggressively shifted to margin pressure and long-term equity returns.
Which means we have to separate the narrative of the sleek vehicle on the road from the equity mechanics operating on the balance sheet. To do that, we need to establish the parameters of our common ground.
Right, because the prevailing discourse, which routinely devolves into branding Xiaomi as either, China's Tesla or a pure margin trap, is highly reductive.
It really is. So, first, we state definitively that the Xiaomi EV launch is a tangible industrial reality. Let us be absolutely clear on terminology here. This is not a vaporware story engineered by executives to drive multiple expansion.
No, not at all.
Multiple expansion occurs when Wall Street decides a company's future earnings are so promising that they are willing to pay a higher price for every dollar of current profit. Startup EV makers often sell a dream of autonomous software margins to convince the market to value them like tech companies.
Right, rather than metal benders?
Exactly. Xiaomi is not relying on promotional accounting or pre-revenue concept hype to achieve that.
Precisely. The delivery of over 500,000 units in 2025 removes the vaporware argument entirely from the table. Furthermore, the industrial relevance is cemented by their forward guidance.
They have some very firm targets, right?
They do. They have established a highly credible, firm 2026 target of 550,000 units. And that volume is backed by 4 new planned vehicle models already entering the pipeline. The SU7 has aggressively transitioned from a headline-generating novelty into a state of permanent, undeniable industrial relevance.
But acknowledging their industrial relevance brings us directly to the second piece of consensus, which requires intense scrutiny. And that's the ecosystem advantage.
Which is the core mechanism of the bull case.
Right. Xiaomi did not enter the automotive sector from a standing start, which is what typically destroys EV startups. They entered it leveraging a global MIUI monthly active user base, their proprietary Android operating system interface. And that base is exactly 641.2 million users.
And that figure is the lever that moves the entire strategy. Break down the geography of that installed base for a second. Critically, exactly 155.5 million of those monthly active users reside directly in mainland China.
That is a staggering domestic footprint.
It is an asset of profound consequence. I mean, consider the mechanics of customer acquisition cost, or CAC. For a traditional legacy automaker or a pure-play EV startup, acquiring a single customer involves massive expenditures.
Television advertising, digital marketing, physical dealership incentives.
Exactly. Brand awareness campaigns. Xiaomi systematically bypasses that friction. They construct a native software distribution layer before the physical vehicle is even manufactured. They have a pre-existing, daily, high-touch consumer relationship.
They're already in the consumer's pocket.
Right. They can market a $30,000 vehicle directly on the lock screen of 155 million Chinese consumers for an effective marginal distribution cost of zero.
The customer acquisition advantage is mathematically sound, sure, but I argue it is effectively neutralized by the reality of the funding base supporting it. This brings us to the third piece of our common ground.
The capital engine.
We must forensically dissect the capital engine powering this automotive expansion. The bull case projects an effortless cross-subsidy, where the tech ecosystem pays for the car factories. But we must look at the precise fiscal year 2023 figures to understand why that funding base is dangerously thin.
Walk through the segment constraints. Let's look at the numbers.
Okay, in FY 2023, Xiaomi's smartphone division generated an impressive 157.5 billion RMB in revenue. However, it generated that massive top-line figure at a profoundly tight 15.4% gross margin.
Which is typical for hardware, but still thin.
Right. Moving to their connected home devices, the IoT and lifestyle segment generated 80.1 billion RMB, but again, operating at only a 17.7% gross margin. The structural anomaly is the Internet Services division.
Because of the software economics?
Exactly. It produced a tremendously rich 73.1% gross margin.
Which on paper looks like the perfect cash engine to fund a new venture.
It would be if it possessed any real scale, but that 73.1% margin is generated on a meager 30.1 billion RMB of total revenue.
Ah.
Yeah, the highest margin business is structurally too small to subsidize massive industrial Capex alone. Conversely, the largest businesses, smartphones and IoT, operate on margins that are simply too thin to casually finance the brutal, relentless capital expenditure required for automotive scaling.
And that is the crux of the debate. Can a 15.4% margin hardware business safely fund an automotive expansion that routinely incinerates billions of dollars in free cash flow during its initial 5 years?
History suggests it's incredibly difficult.
To answer that, we really have to leverage the most instructive historical consensus case. We must look outside the automotive sector entirely and narrate the Amazon and AWS incubation story of the early 2000s.
The parallels there are exact, but the outcome is what we must debate.
Let us establish the Amazon narrative in full. In the immediate aftermath of the dot-com collapse, Amazon was operating a retail e-commerce business characterized by notoriously thin margins, often operating at a net loss or a razor-thin single-digit profitability.
Right.
Jeff Bezos made the highly controversial strategic decision to utilize the operating cash flow from that low-margin retail engine to fund a completely uncertain, highly capital-intensive new technology platform, Amazon Web Services.
He was effectively taxing a low-margin business to build massive, expensive server farms for a B2B service that did not yet possess a proven market.
Exactly. And Wall Street's reaction at the time was intensely, ruthlessly critical. institutional investors focused relentlessly on the immediate dilution of returns.
They viewed funneling e-commerce cash into enterprise server farms as a catastrophic misallocation of capital. I mean, they demanded valuation discipline. They wanted Amazon to focus on turning a profit on selling books and CDs, not incinerating cash on cloud computing infrastructure.
But the believers focused on the potential of platform adjacency. The historical reality validated both perspectives, but ultimately rewarded the believers. The near-term dilution was real and painful for early equity holders.
Extremely painful.
Yes, but AWS eventually evolved into a definitive, high-margin franchise that effectively subsidizes the entirety of Amazon's retail logistics network today. The exact mechanism of that success is the threshold question for Xiaomi.
But that is the critical differentiation here. AWS succeeded strictly because Amazon's core e-commerce cash engine, despite its thin margins, achieved a monopolistic scale that made it exceptionally deep and structurally durable.
You're saying it had more runway.
Exactly. It was able to support years of sustained capital expenditure without breaking the parent company's balance sheet.
Which means the debate today is no longer whether consumer electronics and automotive platforms share theoretical adjacency. They clearly do. The debate is strictly whether Xiaomi's smartphone and IoT cash engine is demonstrably deep enough to sustain this transition through the inevitable automotive cash burn cycle without destroying the equity value in the process.
So let's transition directly into the formalized bull case to examine if that depth exists. The primary thesis is the concept of the ecosystem functioning as an industrial launchpad.
Right.
The premise is that Xiaomi fundamentally disrupts the traditional automotive entry economics because they bypass the startup phase entirely.
Exactly. Think about the sunk costs of a traditional EV startup like Rivian or Lucid. Establishing brand awareness, building consumer trust, constructing retail distribution networks from scratch.
Not to mention architecting the software infrastructure.
Right, and securing procurement leverage against Tier 1 suppliers. That represents billions of dollars in upfront capital. Xiaomi begins with all of those assets fully operational.
They skip the line.
They arrive at the starting line of the automotive industry with mature software competency, massive procurement leverage built over a decade of smartphone manufacturing, and an installed user base deeply conditioned to trust Xiaomi hardware.
And you frame this through the Apple adjacency mechanism. Explain the transition mechanics there.
We have to look at Apple's expansion from the iPhone into the Apple Watch and AirPods. Apple did not achieve absolute market dominance in wearables because watches and wireless earbuds were inherently superior standalone product categories upon launch.
They succeeded because of the ecosystem pull.
Exactly. They succeeded because the iPhone created an inescapable gravity well. The existing iOS ecosystem made the adoption of adjacent hardware products entirely frictionless. You didn't evaluate the Apple Watch against a Garmin strictly on technical merits.
You bought it because it's seamlessly integrated with the device already in your pocket.
Yes. And Xiaomi is attempting to execute this exact adjacency leap through their human car x home strategy.
They are mapping the Apple wearable strategy onto a 2-ton vehicle.
Precisely. The vehicle ceases to be an isolated transportation purchase. It becomes an integrated extension of a digital lifestyle already anchored in Xiaomi phones, Xiaomi wearables, and Xiaomi smart home infrastructure.
You step into the SU7 and your environment is instantly synchronized.
Right, which theoretically obliterates the traditional customer acquisition costs and opens massive avenues for high-margin post-sale software monetization.
The fundamental difference and the source of the immense structural risk is that they are attempting this frictionless ecosystem leap into a category with a vastly higher ticket size.
Well, price is a factor.
It's the defining factor. A consumer will impulse buy a $200 set of wireless earbuds to stay in the ecosystem. Buying a $30,000 to $40,000 vehicle requires financing, insurance, complex depreciation calculations, and physical safety trust. The leap carries exponentially higher physical and strategic importance.
But that is exactly why the second pillar of the bull case centers on manufacturing learning transfer. Xiaomi is not just a software company. They possess profound institutional experience in hardware scaling.
They know how to build things fast.
Right. Their legacy in smartphones provides them with deep expertise in supply chain orchestration, aggressive vendor bargaining, rapid inventory turnover, and ruthless cost discipline.
But the automotive supply chain is distinctly different from consumer electronics. Sourcing an OLED screen for a phone does not train you to source automotive-grade steel or manage the thermal dynamics of an 80 kilowatt-hour battery pack.
The physical components differ, absolutely. But the fundamental mechanics of procurement, scale, offer leverage that smaller pure-play EV competitors simply cannot access. When Xiaomi walks into a semiconductor supplier, they are negotiating for millions of smartphone chips alongside their automotive chips.
So they command pricing power.
Volume commands pricing power. Furthermore, their early ability to post a profit in the auto segment, no matter how modest the initial figure, provides immense symbolic and operational validation. It directly punctures the primary bear thesis that Xiaomi would be trapped in a state of permanent auto subsidy, bleeding cash indefinitely.
To fully evaluate their capacity for industrial scaling, we really must invoke the BYD analogy. Specifically, we must look at BYD's trajectory from roughly 2020 to 2022.
It is critical to establish the structural difference first, though. Xiaomi does not mirror BYD's deep vertical integration.
Right. BYD's supreme advantage is that they manufacture their own battery cells internally at scale.
Exactly. Xiaomi relies on external suppliers for their cells. However, the market is currently making the exact same analytical error with Xiaomi that it made with BYD half a decade ago.
Explain the nature of that analytical error.
In 2020, foreign investors and institutional analysts consistently underestimated the sheer velocity of Chinese industrial scaling. They remained stubbornly anchored to outdated legacy assumptions.
They believed Chinese manufacturers lacked brand execution.
Right, they assumed they suffer from perceived quality deficits and were fundamentally incapable of capturing premium market segments from European incumbents. BYD shattered those assumptions through relentless, rapid iteration and supreme manufacturing skill.
And you see Xiaomi doing the same?
Xiaomi is weaponizing that exact same industrial velocity. They are moving from design to mass production at a speed that Western legacy automakers find physically impossible to replicate.
But BYD was always a battery company that evolved into a car company. For the ultimate historical analog regarding the transition from a perceived consumer gadget or discount player into a dominant industrial powerhouse, we must recount the Hyundai and Kia Ascent in the United States.
That narrative perfectly maps the psychological barrier Xiaomi is attempting to cross. Detail the Hyundai entry into the U.S. market.
Okay, so when Hyundai entered the U.S. market in the late 1980s with the Excel, and Kia followed in the early 1990s, the automotive establishment universally dismissed them. They were categorized strictly as cheap, low-trust, entry-level discount vehicles.
They were the punchline of late-night television monologues.
Literally. Early quality control issues, powertrain failures, and rapid depreciation severely damaged their initial brand equity. Consumers bought them solely because they were the absolute cheapest option available.
But observe the strategic pivot they executed. They didn't just retreat to their domestic market. They initiated a relentless multi-decade industrial ascent.
To counter the overwhelming deficit of consumer trust, they introduced that unprecedented 10-year, 100,000-mile powertrain warranty.
Exactly. This was a brute force financial mechanism designed to forcefully, artificially establish consumer trust, while their internal engineering capabilities caught up to the Japanese and American incumbents.
Wall Street analysts at the time predicted the warranty costs would bankrupt Hyundai.
Instead, it forced rigorous internal quality control. Over the subsequent decades, their manufacturing quality improved drastically. Their dealership networks expanded. They hired elite European designers.
The entire consumer value perception fundamentally shifted.
Right. They evolved from being a discount punchline to dominating market share and eventually launching genuine premium marques like Genesis, which now directly competes with Mercedes-Benz and BMW.
And the core bull case for Xiaomi rests on this exact historical migration pattern. They are attempting to compress Hyundai's 3-decade evolution into 3 years.
Yes.
They are transitioning from a consumer gadget manufacturer known for affordable air purifiers and mid-tier smartphones into a deeply serious, globally relevant industrial contender.
And the 500,000 deliveries in 2025 prove that the migration is already succeeding.
That is a formidable product narrative. I concede that. But we must now pivot to the bear case, because excellent product execution does not automatically translate into durable equity economics.
Fair enough.
The bear case is rooted in a structural reality that consumer enthusiasm cannot simply override. We must re-examine the structural margin strain. We established definitively that Xiaomi's largest core businesses operate in the mid-teen gross margin range. Smartphones are at 15.4%.
A tight margin, sure, but a profitable one on massive volume.
Profitable enough to sustain a phone business, but they are attempting to scale an automotive business directly into the teeth of the most brutal EV price war in Chinese history. The automotive sector is historically a structurally difficult, highly cyclical, capital-intensive, low-margin business.
The implication being that the celebrated cross-subsidy strategy, where smartphone profits painlessly fund car development, works perfectly in a theoretical slide-back, but deteriorates rapidly under live macroeconomic stress.
Exactly. Relying on low-margin consumer electronics to fund low-margin automotive hardware during a deflationary pricing war is not a flywheel. It is a massive, compounding financial strain.
Let's look again at those segment constraints.
Right. You have 157.5 billion RMB from smartphones at 15.4%. You have 80.1 billion RMB from IoT at 17.7%, and the high-margin Internet Services division sits at just 30.1 billion RMB.
So the math doesn't support the ambition.
Exactly.
The lucrative software business is mathematically too small to carry the enterprise Capex. The massive hardware businesses are too thin to absorb prolonged macroeconomic shocks.
Which brings us directly to the immediate, tangible operational threat: the memory cost squeeze. This is not a theoretical risk discussed in white papers. It is actively impacting the profit pool right now.
It's a massive headwind.
In the first quarter of 2024, DRAM memory prices surged aggressively, rising by roughly 15 to 20%. Furthermore, forward projections indicate continued sustained increases into the second quarter and beyond.
Explain for the listeners why a commodity component price increase critically threatens the EV strategy.
Because modern EVs are essentially rolling data centers. They require massive memory allocations for autonomous driving processing, complex infotainment systems, and real-time telemetry. If DRAM prices surge 15 to 20%, the physical cost of manufacturing the SU7 instantly increases, compressing the already tight automotive margin.
And there's a dual threat here.
Yes, smartphones also require massive memory allocations. The exact profit pool Xiaomi relies upon to fund its multi-billion-dollar EV expansion, the smartphone margin, is being squeezed simultaneously. When memory costs spike, the cross-subsidy engine stalls on both ends of the business.
And we must elevate this beyond standard cyclical commodity volatility. The geopolitical analysis is unyielding here. Semiconductor and memory pricing are no longer simply matters of procurement efficiency. They're strategic variables.
We are dealing with extreme supply chain concentration.
Exactly. The vast majority of high-performance memory is fabricated in Taiwan and South Korea, operating entirely under the umbrella of a broader, rapidly escalating U.S.-China technology conflict.
You are arguing that component access is a geopolitical choke point.
It is the ultimate choke point. Sourcing memory is subject to sudden, severe geopolitical dislocation, export controls, and tariff barriers. If the smartphone margin is squeezed by external memory cost inflation, driven by geopolitical tension, the capital lifeline feeding the automotive division is instantly choked.
The equity becomes functionally paralyzed.
Exactly. And if the funding lifeline is fragile, then we must forcefully confront the capital expenditure reality check. Xiaomi has publicly committed to a stated $10 billion investment over a decade to build this automotive business.
In the context of consumer electronics, $10 billion is a staggering, almost unfathomable sum. You can develop an entirely new ecosystem of wearables and smart home devices for a fraction of that.
But in the context of global automotive manufacturing, $10 billion is severely inadequate. We must contrast their stated commitment with brutal industry realities.
The true cost of entry.
Right. Conservative analysis of historical EV scale-ups demonstrates the true cost. Initial research and development, physical manufacturing plant construction, deep supply chain localization, and the deployment of regional sales and service networks require between $11 billion and $22 billion in immediate, upfront capital just to achieve minimum viable scale.
So you view the $10 billion commitment as a down payment, not a completion budget.
It is barely a down payment. This exposes the most dangerous blind spot in the entire equity debate. Wall Street analysts accustomed to modeling software and smartphones are misjudging the physical reality of the product. Cars are fundamentally not phones.
The life cycles are entirely different.
Completely. A smartphone's life cycle is short, perhaps 2 to 3 years. It is easily replaced, and it carries minimal physical liability. If a smartphone battery degrades, the user buys a new phone.
But the life cycle of a vehicle dictates an entirely different economic burden.
The hidden killer in automotive scaling is not successfully manufacturing and shipping the first unit. The killer is carrying the immense, multi-decade lifetime burden of the vehicle.
Warranty claims.
Exactly. Automakers must finance heavy warranty claims over a decade. They must execute physical recalls that require parts and labor. They must sustain continuous over-the-air software maintenance across rapidly aging fleets with divergent hardware profiles. They must manage complex global parts logistics networks.
And residual values?
Yes, they must actively support secondary market residual values to ensure their leasing economics do not collapse. They must coordinate deep financing partnerships and integrate with insurance providers.
Most importantly, they have to build a nationwide physical service density. A malfunctioning smartphone can be mailed back to a regional depot in a padded envelope. A 2-ton vehicle requires a specialized, localized, highly trained physical infrastructure.
You need service bays, heavy lifts, and certified high-voltage technicians stationed within a reasonable driving distance of every single customer.
That reality connects directly to the issue of the brand ceiling. The bull case assumes Xiaomi can simply march up the pricing ladder to achieve high margins, but the brand ceiling was violently exposed by the SU7 Ultra data.
We need to analyze the specific failure of the SU7 Ultra.
Right. The SU7 Ultra was explicitly positioned as the premium halo trim of the lineup. It was engineered with extreme performance metrics intended to demonstrate pricing power and high margin capability. It was supposed to prove that Xiaomi could command Porsche-level prestige.
But the data shows an absolute collapse of that specific trim. Deliveries of the SU7 Ultra fell to fewer than 50 units.
Well, I would argue that is a singular execution error on a specific trim level, a misjudgment of the target demographic's immediate appetite for a hyper-performance variant.
I disagree. It is not a singular error. It is a structural revelation. The strategic implication is severe. It suggests a hard cap on consumer willingness to pay a true luxury premium for the Xiaomi badge.
You think the brand can't stretch that far?
Right. It indicates that while consumers will eagerly flock to a high-value, aggressively priced, tech-forward Xiaomi vehicle, the brand equity entirely evaporates when attempting to compete in the genuine luxury, high-margin strata. If they cannot sell the Ultra, their path to high gross margins is permanently blocked by their own brand identity.
To truly understand the existential danger of ignoring capital intensity and brand ceilings, we must analyze the Leo Eco cautionary tale from 2015 to 2017. This is the exact scenario short sellers are modeling.
Narrate the Leo collapse for us.
Jia Youting founded Li Eco and successfully built a mesmerizing narrative of an omnipresent digital ecosystem. They started with video streaming. They were frequently lauded as the Netflix of China.
Right.
From that highly visible platform, they aggressively expanded into smartphones, smart televisions, and ultimately massive capital-intensive ventures, including the Faraday Future and Lisi electric automotive projects.
And Jia Yiting utilized the exact same glow of ecosystem synergy that Xiaomi currently projects. He used the concept of an integrated digital life to justify immense capital expenditure across entirely disparate hardware categories. The market initially rewarded the ambition.
But the empire simply expanded faster than the underlying cash engine could sustain. By 2017, the structural reality broke the narrative. Severe liquidity stress paralyzed the company.
The cash bleed from the automotive and hardware divisions overwhelmed the streaming revenues.
Exactly. Suppliers were left unpaid, manufacturing projects stalled indefinitely, the equity collapsed entirely, and the entire ecosystem dream unraveled completely.
Now, we must state clearly and responsibly, Xiaomi is categorically not Li Eco. Xiaomi's operational execution, their rigorous balance sheet management, their massive cash reserves, and their actual physical product delivery are vastly superior and deeply credible. Lei Jun is not Jia Yiding.
But the underlying macroeconomic lesson of the Li Eco collapse remains completely durable. Immense ecosystem prestige and genuine consumer brand love do not, and cannot, repeal the laws of capital intensity. You cannot pay suppliers with ecosystem synergy.
We can pair that historical lesson with a more recent direct automotive parallel, NIO between 2021 and 2022. NIO is the perfect example of excellent product failing to generate durable equity returns.
NIO possessed a flawless narrative. They offered elite branding, gorgeous vehicle design, and unprecedented service differentiation with their proprietary battery swapping infrastructure.
They established undeniable leadership in the Chinese premium EV sector.
Right. Their ecosystem of physical NIO houses, exclusive clubhouses for owners, created massive user loyalty and brand devotion.
Yet, as industrial competition intensified across the sector, the sheer capital intensity required to maintain that sprawling physical service infrastructure remained relentlessly high.
Building and stocking hundreds of automated battery swap stations requires staggering amounts of continuous capital.
When NIO's automotive margins disappointed the market's aggressive projections, the stock suffered a brutal, sustained derating. NIO proved definitively that you can build a universally beloved brand, engineer excellent cars, foster deep consumer loyalty, and still incinerate shareholder value if the underlying equity economics are structurally flawed.
The tension between the product triumph and the equity vulnerability requires us to transition to the strategic frameworks and analogies that best clarify this situation. We will utilize 6 specific analytical lenses provided in our source data to evaluate Xiaomi's current position.
Let's do it. The first framework is the gaming meta shift.
Right. In competitive gaming, a meta shift occurs when a new strategy or character temporarily disrupts the established rules of engagement before the rest of the ecosystem adapts. Xiaomi's SU7 launch has created a massive, temporary meta shift in the Chinese EV market.
They entered with aggressive pricing, disruptive technology integration, and massive scale.
Exactly. They have forced every legacy incumbent from BYD to Geely to Tesla to react to their strategy.
But the critical question for the equity is whether this new strategy is structurally durable or simply a temporary disruption that heavily capitalized incumbents will eventually neutralize through sheer scale and margin compression. A meta shift wins a single tournament. It does not guarantee a 10-year franchise.
Second, the matrix code analogy. Xiaomi is not merely transacting a vehicle sale, they are attempting to show consumers the underlying code of an integrated mobility stack.
Right. They want the user to experience the seamless, invisible communication between their smart home infrastructure, their mobile device, and their daily transportation.
If they are successful in demonstrating this matrix code, the switching costs for the consumer become insurmountably high. You will not buy a competing EV if it breaks the integration with your entire digital life.
Third, the blockbuster franchise framework. A hit movie franchise can generate immense initial revenue, which the studio uses to fund increasingly ambitious, expensive sequels.
However, the iron rule of Hollywood and industrial scaling alike is that eventually the cross-subsidy must end.
Every sequel and every new product line must eventually stand on its own economic merits or risk bankrupting the entire studio. The automotive division cannot be subsidized by 15.4% margin smartphones indefinitely. The SU7 must generate its own compounding cash flow.
But the most powerful framework, the one that perfectly encapsulates both the monumental ambition and the severe financial danger, is the 19th century railroad analogy. We must unpack this historical parallel fully.
It's the most resonant one.
Xiaomi is essentially attempting to fund the construction of a 21st century railway system using the operational profits derived from selling mobile phones.
Explain the capital dynamics of the 19th century railroad expansion.
In the 19th century, the expansion of the United States transcontinental railroads required an unprecedented mobilization of capital. Laying thousands of miles of steel track across hostile terrain required massive federal land grants, massive continuous bond issuances, and repeated deeply dilutive financing rounds.
The reason for that relentless capital requirement was simple mathematics. The operating revenues generated from the early partial rail lines could not come close to comfortably funding the massive physical build-out required to reach national scale.
You could not fund a track to California using the ticket sales from a track in Ohio.
Exactly. The infrastructure had to be laid at immense upfront cost before the real compounding network revenue could be realized.
The historical outcome of that expansion is vital for equity investors to understand today. The railroads absolutely succeeded in their physical mission. The physical product was an undisputed triumph.
The winners unified the continent, collapsed transit times, and fundamentally shaped the modern American industrial economy.
However, the financial reality for the early equity holders was absolutely devastating. Because of the constant unyielding need for fresh capital to lay the next mile of track, many early investors were entirely diluted, completely wiped out, or forced through brutal financial restructurings before the networks finally matured and generated stable returns.
By the late 19th century, a massive percentage of U.S. railroads had entered receivership.
Excellent industrial infrastructure frequently creates terrible initial equity outcomes. The SU-7 is the track. The cars are on the road. The physical triumph is real.
But the massive capital required to build the nationwide service centers, the charging equivalents, the localized parts logistics, that invisible infrastructure could dilute current equity holders completely before the compounding returns ever materialize.
That brings us perfectly to the fifth framework, the invisible economic infrastructure. We briefly touched on the after-sales burden, but we must classify this as the ultimate wildcard.
The real test of Xiaomi's EV business over the next 36 months is not their manufacturing scale. It is not even their near-term gross margin on the vehicle itself at the point of sale.
The true test is whether Xiaomi can successfully construct the invisible, highly expensive economic infrastructure of a legacy automaker without the broader equity market noticing the severe cash drain until it is too late to react.
We must reiterate this point forcefully. The economic story of an automobile begins after the sale, not at the moment of the transaction.
Glamorous product launch narratives and slick keynote presentations inevitably transform into ugly, grinding cash flow realities when an automaker must establish massive warranty reserves on their balance sheet.
They must fund localized parts logistics networks to ensure rapid repair times. They must manage residual value support so their vehicles do not collapse in the secondary market. If the SU-7 loses 60% of its value in year one, their leasing economics are permanently destroyed.
To illustrate the sheer cliff face of automotive economics, we must look at the Dyson counter-narrative. James Dyson's attempt to enter the EV market is the perfect counterintuitive case study. It proves that money and engineering talent are not enough.
Detail the scale of Dyson's ambition for us.
In 2017, James Dyson announced a massive, highly publicized push into the electric vehicle space. This was not a side project. It was backed by a direct corporate commitment of more than £500 million in initial investment.
They were deeply committed.
Dyson possessed an unimpeachable global reputation for premium engineering, advanced aerodynamics, and proprietary solid-state battery technology. They hired elite automotive executives. They developed fully working, highly advanced prototypes.
They even designed a state-of-the-art, bespoke manufacturing facility intended to be built in Singapore.
Yet, by 2019, the entire project was completely scrapped. It was publicly and unceremoniously abandoned.
Why? I mean, it was not a failure of engineering talent. The prototypes worked beautifully. It was not a failure of corporate ambition or a lack of imagination.
It was scrapped because James Dyson reviewed the final unforgiving financial modeling. He realized that to make the business commercially viable, lacking the scale of a legacy automaker, they would have to sell each vehicle for an astronomical sum, over 150,000 pounds, just to break even on the unit economics.
The brutally difficult, unyielding economics of making a car business work at global scale proved mathematically impossible for a company lacking a massive existing automotive supply chain.
Dyson made the rational choice to protect his core, highly profitable consumer appliance business, rather than incinerate it trying to scale a structurally disadvantaged automotive operation. The bear case asks if Lei Xun should have made the same calculation.
So we have systematically disassembled the competing narratives, the historical analogies, and the financial constraints. It is time to synthesize the data into a definitive structural assessment.
Deepest, most actionable truth for institutional capital is that Xiaomi's EV story is unequivocally real at the product level, but it remains dangerously fragile at the equity level. It is crucial for investors to understand that these two facts are not contradictory. In fact, holding both of those realities in tension is the entirety of the investment case.
Xiaomi has thoroughly and aggressively disproven the lazy initial market skepticism. The 500,000 deliveries prove beyond a doubt that they can build a highly desirable electric vehicle at massive scale.
The 2-to-1 sales ratio over the Tesla Model Y proves they can generate extraordinary sustained consumer interest against the industry's apex predator.
The seamless ecosystem integration proves they can successfully convert existing smartphone trust into hard automotive demand. And they have scaled their manufacturing output significantly faster than even the most aggressive bullish analysts projected.
However, product validation does not equate to self-funding economic durability. The case for holding the stock remains substantially weaker than the case for buying the car.
Automotive economics, with their immense capital requirements, cyclical demand destruction, and relentless depreciation schedules, do not bend easily to the romance of a software ecosystem. Xiaomi is currently operating in a highly dangerous transition zone.
Define the transition zone.
Well, they have moved past phase 1, which is market disbelief. Nobody doubts their ability to build a car anymore. They have moved past phase 2, which is the period of easy, narrative-driven equity gains, based on successful product reveals and initial delivery beats.
They are now entering the most punishing phase of the industrial cycle. This is the phase where the market entirely stops trading on narrative momentum and demands hard mathematical proof.
The market now demands proof that rapid revenue growth can successfully coexist with acceptable gross margins and durable returns on invested capital.
To contextualize this specific, brutal phase, we must use our final historical composite. The most accurate analogy for Xiaomi right now is not Tesla in 2020 and 2021, when capital was virtually free and multiples were detached from reality. Nor is it a pure reflection of NIO in 2021 and 2022.
The precise composite is a dangerous blend of BYD's aggressive industrial scaling success bolted directly onto NIO's grim margin reality.
If we look for a singular historical moment that perfectly mirrors Xiaomi's current operational tension, it is Tesla's Model 3 rollout period between 2017 and 2018. During that exact period, Tesla possessed overwhelming global consumer demand. They had hundreds of thousands of pre-orders.
They possessed a historic, untouchable brand halo.
Yet they entered what Elon Musk accurately and famously described as production hell.
That period violently exposed how massive consumer demand, immense Capex requirements, severe physical service infrastructure gaps, and deep manufacturing complexity can completely collide and nearly bankrupt a company.
Tesla was weeks away from collapse, not because consumers didn't want the cars, but because the economics of building them at scale were violently difficult.
Tesla ultimately survived that period and validated their long-term equity story. But they only survived because they were able to build a structurally high gross profit architecture driven by software and regulatory credits and secure massive continuous financing capacity from public markets that almost all of their subsequent imitators have completely failed to replicate.
Xiaomi must now navigate that exact same crucible, but they must do it while relying on a 15.4% smartphone margin to keep the lights on.
With the synthesis established, we move to the final segment of this briefing. We will now outline the 7 strict tactical directives that this data mandates for immediate portfolio construction.
Directive 1. You must violently separate the product thesis from the stock thesis. Xiaomi's EV product market fit is definitively established and highly credible.
However, the equity absolutely requires a permanent structural discount applied to its valuation to account for the immense capital intensity, the memory cost exposure, and the margin fragility we have detailed today. You cannot price this like a pure software company.
Directive 2. Avoid chasing the China's Tesla multiple. Applying a software or pure-play EV premium multiple to Xiaomi is a fundamental analytical error.
The correct valuation comparables are margin-constrained industrial scalers like BYD or narrative-rich but economically inconsistent operators like NIO.
Directive 3. Maintain strict sizing discipline. We advise using a tactical rather than heroic position size. The data dictates maintaining roughly a 2% to 3% active underweight position over the next 12 to 18 months.
You only revise that underweight position if we see margins broaden in a structurally meaningful, sustained way across the entire enterprise, not just a localized bump in a single quarter.
Directive 4. This is the operational tripwire. You must monitor smartphone gross margins as the definitive real-time indicator of EV funding health. We established the smartphone margin is currently 15.4%.
If that smartphone gross margin falls toward or breaches below 12% for 2 consecutive operating quarters, whether due to DRAM cost spikes or consumer weakness, the cross-subsidy model becomes materially, fundamentally fragile. A 12% margin simply cannot sustain this automotive capex.
Directive 5. Track EV scale and quality simultaneously, never in isolation. Volume without margin is industrial suicide. It simply accelerates the cash burn.
The metric for operational durability requires sustained vehicle deliveries above 20,000 units per month, combined strictly with an EV gross margin maintained above 10%. Anything less indicates they're buying market share through aggressive pricing at the direct expense of equity viability.
Directive 6. Do not ignore the deployment of the physical service network. The invisible infrastructure will dictate the actual cash flow.
You must rigorously monitor their stated warranty provisions on the balance sheet. Track the physical density of their localized service centers. Measure average repair turnaround times, and calculate the direct cost of any physical software or hardware recalls.
Directive 7. Execute intelligent hedging. Do not hold this exposure in isolation. Pair any long Xiaomi exposure with fundamentally stronger, highly capitalized industrial incumbents who possess diverse profit pools.
Alternatively, offset the risk with tactical short positions in overvalued EV-adjacent names that lack Xiaomi's baseline hardware profitability.
We have reached the bottom line of this strategic briefing. Xiaomi has undeniably accomplished the exact industrial feat that the vast majority of skeptics insisted was utterly impossible.
They have engineered, manufactured, and delivered a legitimate hit EV business. They have demonstrated real, physical manufacturing scale. They have generated massive, verified consumer demand, and they have provided early, tangible evidence of initial segment profitability.
But the market's central, potentially catastrophic mistake right now may be operating on the assumption that proving you can physically sell cars is functionally the same thing as proving you can earn durable, compounding equity returns from them. It is not. The right conclusion is not that Xiaomi's EV dream is fake. It is that a great launch can still be a bad compounding machine.
This is the Research Desk officially signing off.